Good morning. How are you doing? Thursday the 19th. This is what we're talking about. Tech. OpenAI is raising money. Samsung is raising prices. Hikes apparently are back on the agenda at the Fed. Surprise, surprise. And crude is still climbing as the risk of another Gulf War grows, Tom.
So the tech enthusiasm is there, to your point on Samsung, and you're seeing that reflected in the Kospi, up more than 3% so far in the session. It's the chip story that is really of impact, of course, with the funding raise coming through from OpenAI. The Nasdaq performed pretty well yesterday stateside. European futures today currently flat after another record high yesterday. Brent crude up 0.2%, holding above $70 a barrel on those concerns around the Middle East and Iran. The countdown to the opening trade starts right now.
Thursday the 19th, good morning. So, Tom and me this morning, got lots to talk about. Lots of tech. Mike, Tom's here, of course, lots of tech. Let's start talking a little bit about what is going on. OpenAI is raising lots of money. Great. Samsung raising prices. Are those two things connected, do you think?
If you have a valuation of, what, close to $850 billion on this $100 billion raise, how they're going to be spending that, a big chunk of that spending is going to come through in terms of the capex. They have committed to, OpenAI has committed to literally trillions of dollars of capex spending.
Yep.
And that is going to have a trickle-down effect.
Where do you want to be,
for the likes of Samsung, which is now raising prices by 30% with this new memory chip.
30%, that's amazing. That feels inflationary to me, because this stuff is this stuff is going to affect everything in terms of the price raises that we're going to see. Consumer electronics, all kinds of stuff are going to be affected by what happens here. But where do you want to be? Do you want to be at the top end? Do you want to be in the OpenAI investing that space? Or do you want to be in the Samsung's making lots of money because OpenAI is spending lots of money kind of place? I don't know. It's really interesting kind of where in the hierarchy you want to invest at this point.
Yes. So that brings us onto a question of valuations and how much has been priced in to some of these South Korean names. How much has been priced in to the likes of SK Hynix and Samsung? How much risk is in the other part of the stream, which is, of course, the OpenAIs, whether or not they can actually monetize this as they lead up to a potential IPO. So where you want to sit is a really, really good question. And has the window closed on some of these hardware and chip makers, or is there still an opportunity to get exposure, given that many see this potentially as a super cycle for the chip space that could stretch well into 2027?
I think you more broadly, you've seen a bounce in tech over the last 24 hours. Am I yawning about that? Do I think that's boring? Because effectively we've seen these stocks beaten up over the last few days. You were going to get a bounce at some point. This maybe is it. I'm just wondering how I can connect the dots of OpenAI, Samsung, and the tech bounce. Are they connected? I can see the first two being connected. Is the last one connected? Or was it inevitable that at some point tech stocks were going to bounce?
Yeah, there's this. People are still feeling the story. They're still trying to get to grips with what is all happening in terms of the agentic shift and the ability for these new models put out by companies like Anthropic to change the way that we interface with our computers in work and at home. And so that story is still not clear. But what is clear, and what seems to be much clearer, is there will continue to be demand for these chips, and there aren't enough of them. And that is quite clear, that narrative. The narrative around the AI disruption trade seems to be less clear. What we're also seeing is question marks about the societal impact, not of AI yet, but of social media, which seems to be backward-looking. But we've been hearing from President Macron over in India at the AI Impact Summit and taking something of a targeted potshot. We can take a listen to what President Macron had to say when it comes to social media firms and their claims of free speech.
Some of them claim to be in favor of free speech. OK, we're in favor of free algorithm. Totally transparent. Because, free speech is a pure bull. Nobody knows how you are guided through this so-called free speech.
OK, the French president there, not mincing his words when it comes to the big tech claims around protecting free speech. What happens when AI is infused with social media and the societal impacts there in terms of our attention and what it does to young people, I think is a question that lawmakers and policymakers are starting to think about.
So just to bring it back to kind of how you value this stuff. Meta at the moment, free cash flow is really important. But if you start to hit some of that, does it need to raise more debt? And therefore, does that exacerbate the debt issue? So I'm just wondering if the moment the sort of the social media side is the cash cow that delivers, and we'll fund the AI stuff. If that doesn't happen, do you need more debt, and does that kind of cause consternation in that kind of relationship as well? Let's talk about the Fed. Samsung raising prices feels inflationary. Inflation, yes. The Fed is worried. The Fed, some people are talking about hikes. We're not there yet by any stretch of the imagination in actually delivering hikes, but the conversation started.
It's pretty remarkable that the market didn't react more, it seems, to these minutes that came out yesterday, with several members, according to the minutes, several members suggesting the Fed may need to raise rates. Here's the caveat: if inflation stays high. We have seen some progress on inflation, but to your point, there does seem to be a marked shift away now from concerns about the labour market back to concerns about inflation. Are we setting up an epic battle when Walsh takes the helm, if Walsh takes the helm, between Walsh and other members of the FOMC?
If you wanted to preserve Fed independence, what would you do at this point? You would start arguments that basically point in the other direction than Trump wants the Fed to go in. And you do slightly wonder whether or not this is pre-Walsh positioning. And some people on the FOMC are taking that view, because there's people like Daly are out there also talking about the idea that AI could actually raise inflation, because there's this whole kind of Greenspan-esque argument that AI is going to produce this productivity boom and therefore actually you can lower rates. But there is another way of looking at it, which is Daly's point of view, I think it's Daly and others, saying basically it's going to suck up all the money and therefore actually the neutral rate will be higher, not lower. So we need to raise rates, not lower rates, because of the capex requirement story that AI is going to require. And everybody's just getting ready for Walsh to arrive and just basically laying out their arguments as why rates shouldn't be cut.
What else is inflationary? Chips, but also oil.
Yep.
And how, to what extent is this factored into the thinking of President Trump and his administration as they weigh up their options when it comes to Iran? And we see this really significant build-up of military assets with Brent above $70 a barrel right now. To what extent is the oil price and concerns about cost inflation a constraint on the optionality for the US president?
He doesn't want to see oil prices go up in advance of the midterms, basically, is the argument. So will he start a war with Iran? There was this whole, I was slightly obsessed with it yesterday, trying to figure out whether or not the Iranians had actually shut the Straits of Hormuz or not shut the Straits of Hormuz yesterday, which hasn't happened for a very, very long time. The consensus seems to be that actually oil continued to flow through it. But that is the risk. He's put all this hardware in. Is the hardware there to persuade the Iranians to bow to US demands? Or is the hardware there actually to deliver some sort of military force and start a war effectively in Iran? I don't know. You could argue it from either side, but the oil price at the moment is saying actually there is a risk. And it's interesting that Dubai crude is trading above Brent crude, which also signals in the region they're even more worried about this risk coming through.
Back in June, President Trump said he would take up to 2 weeks to decide on Iran. This is back in June of last year. And then within 2 days, they launched the strikes on the nuclear facilities. If this is a bluff in terms of the military build-up, it is quite the bluff from the Trump administration.
OK. We'll come back to that a little bit later. Huge day for earnings, so we should probably talk about what we are going to be delivering on this programme. We've got some great interviews coming up. Euronext CEO Stéphane Boujnah is going to be joining us very shortly. Air France-KLM's CEO Ben Smith. Really quite optimistic still in terms of premium demand and what he's seeing on the transatlantic routes. Zurich Insurance CEO Mario Greco is going to be joining us as well. Later in the day, we've got some great guests as well, but that's who we're going to be talking about on this show.
What else to be thinking about today, then? The official opening ceremony for the India AI Impact Summit with Modi and President Macron, who we heard from earlier, and tech leaders who will be attending. Some really big names there, including the likes of Sam Altman, Demis Hassabis, of course, of Google DeepMind. On the data front, the US initial jobless claims come through, talking about the labour market of the US, followed by Euro area consumer confidence. That's at 3 p.m. UK time. Another touch on the US consumer. Walmart delivering earnings results before market, plus the mining firm Newmont and Dropbox after market. And on Fed speak, we were going to be hearing from Bosset, Goolsbee and Kashkari. We'll see if they have views on the neutral rate and the AI productivity impact.
Looking forward to all of that. Walmart's going to be fascinating, I think. What else do you need to know this Thursday morning? The Ukrainian President Volodymyr Zelensky has accused Moscow of attempting to drag out the current peace negotiations. It comes after a second day of US brokered meetings in Geneva between Russia and Ukraine broke down after barely 90 minutes. The head of the Russian delegation described the talks as difficult and businesslike, adding that the next meeting will take place soon, but didn't specify when. The Institute of Fiscal Studies says the UK could replace its simple pass-fail approach to fiscal rules with a broader traffic light system to end what it calls the, quote, dysfunctional policy making of recent years. The IFS says an obsession with the so-called headroom has led to a perception that the OBR is de facto setting government policy with its forecasts. Activist hedge fund Elliot Investment Management is pressing the London Stock Exchange to launch a £5 billion share buyback and review its portfolio. Bloomberg has also learned that Elliot wants the exchange to educate investors that AI will actually increase demand for its data rather than replace it. Remember, of course, Bloomberg LP, the parent company of Bloomberg News, competes with LSEG to provide financial news data and information. Talking of which,
staying on that theme, coming up, a timely conversation with Stéphane Boujnah, the CEO of Euronext, as it makes what it describes as strategic acquisitions, plus Airbus hit by a shortage of engines as it struggles to meet demand for the A320. And coming up, we're going to be speaking with the co-founder and VC firm Kembara, which is looking to invest €1 billion in UK and European deep tech. If you have any questions of your own for our guests, do send them to us on IB plus BBTV Go. This is Bloomberg.
45 minutes to the start of cash trading here in Europe. Futures are actually a little mixed around the continent. Number of stocks in focus. Bayer could be interesting. Airbus is going to be interesting. Euronext is going to be interesting as well. Looks like its stock may be under a little bit of pressure this morning. The company overnight saying costs will jump this year, driven by strategic investments and the recent acquisition of the Athens Stock Exchange. The exchange operator says adjusting operating expenses, excluding depreciation and amortization, will be up 13% on last year. That was all a mouthful. So let's kind of simplify things and see what's happening here. Stéphane Boujnah is the CEO of Euronext and joins us now. Stéphane, always a pleasure. Thanks for taking the time to join us today. Look, it looks like costs are going to be higher. Can I assume, or can investors assume, that revenue will rise to match or exceed those costs?
Of course. And that's what we have demonstrated for the past years in a consistent manner. Over the past years, we have consistently under-promise and over-deliver. Over the past years, we have consistently revised the cost guidance downwards in the course of the year. We are building a company based on one single bedrock, which is credibility, and we are investing to grow the company. The company grew for the seventh quarter double-digit growth in top line. The performance of last year was double-digit growth again on top line, on EBITDA and on EPS. So for sure, what we are investing, what is increasing our cost base for the year to come is just about we have acquired admin control last year and we have acquired ATEX in Greece, and we are growing to deliver our organic growth program. So this is something that will feed the growth of the company. And not everyone is focusing on the expansion of the cost base, but don't forget that we are delivering with the cost base is expanding a 62+% in EBITDA margin. So growing the cost base, if you grew double-digit top line and EBITDA, and if you deliver a 62% EBITDA margin, is a good way to invest.
Stéphane, over the last few days, investors have become nervous about financial services companies. They're worried that AI is going to disrupt this business model. It's interesting that Elliot has taken a stake in LSEG, and one of the things they want is LSEG to educate investors that actually AI is an opportunity, not a threat. Is AI an opportunity, not a threat to Euronext? How do you see it playing out when it comes to your business?
Well, I don't want to comment on the LSEG situation. LSEG is a great company with a great leadership that has undertook an amazing transformation over the past few years, and it's the largest market cap in our industry in the European continent. So that's another issue. Where, as far as AI is concerned, we are in a totally different situation vis-à-vis our peers. We did not buy data assets over the past 5 years when everyone was buying data, and when the common song in town was data is the new oil. We did miss the data boat because we did not buy data. We are just finding out that maybe the data boat is turning out to be a Titanic boat. We did not buy data assets just because they were far too expensive on the basis of the way we measure return on capital employed. And we believe that there was no way to justify the price to be paid for those data assets. It turns out that over the past few months and weeks that there is a sort of wake-up call, and people realize that some of those data assets, not all of them, but some of them, are dislocated by AI. We are in a different situation. AI does process information that already exists. AI is a tool for derivative processing of information. What we do in our data business is to create things that do not exist until we create them. That's pure primary data, and this is the price. The price is the output of bid and ask match in a matching engine. Until the bid and ask match in the matching engine, this information does not exist. It's not digitalized. It cannot be captured and processed by AI. That's why what used to be perceived months ago like a raw data is in fact a primary data immune from AI influence. So that's why we are not affected in any way whatsoever by AI for the sake of dislocation of the data business. What is true, though,
Stéphane,
is that we are capturing big time the AI opportunity on the cost base of the company.
Okay. Stéphane, you do rely, and the business model relies, partly at least, on pretty concentrated liquidity. Does AI fragment that liquidity?
No. I mean, again, we need to be clear. Price formation, and I don't want to spend too much time on that because only 40% of our top line is volume related, and only 17% of our business is cash equity trading. But even if it is 17% of our top line, it captures 70% of the bandwidth of questions, and that's fully understandable in the current environment. Fragmentation is the sickness of any market. Consolidation of liquidity is the solution to create high-quality prices. AI is a tool that empowers market participants to augment, to enhance their algo trading and to make their strategy more sophisticated. But when it comes to price formation, the very fundamentals of price formations are concentration of liquidity to create high-quality spreads in the matching of bid and ask.
Stéphane, I speak to a lot of startup CEOs, a lot of tech CEOs. Almost none of them say they're going to be listing in Europe. What are you getting wrong?
Well, I mean, they make their choices the way they want. I think it's a very London-based perception. We have created
I speak to European Stéphane. I speak to European CEOs. I speak to European startup founders. It's an indictment, isn't it? Let me answer your question. The reality is that we have built an exchange with an aggregate market capitalization of companies listed on Euronext, which is 6.8 trillion, which is more than twice the size of the London equity market and 3 times the size of the Frankfurt market. What are the consequences? We got one of the largest IPO just a few weeks ago, a Czech-Slovak company, a company from Prague that had plenty of options. They have decided to list on Euronext, and they have a 30 billion market cap. Another company in the aerospace and defense sector, KNDS, is going to get listed, and they will be listed on Euronext. So the reality is that we have a pipeline of tech companies and aerospace and defense companies that list on the Euronext market, which is significantly higher than the ones that list outside, because the other European markets are small. And the only large liquid markets they can find are NASDAQ and NYSE. So we are in a totally different situation. That being said, you are absolutely right. Europe needs to consolidate more equity markets. Europe needs to consolidate more equity markets because our local equity markets are too small.
Well, let me ask you that question then to wrap things up. We talked about this before. Just back to the Elliot point. Elliot would like LSEG to review its portfolio. Would you talk to Elliot about maybe thinking about acquiring the London Stock Exchange and splitting those two businesses off? Have you had a conversation? Would you talk to Elliot about that option?
We do not talk to Elliot. We have no intention to talk to Elliot. The only body that is empowered to enter into conversations about what they want to do with their assets are the board and the management of LSEG. They know that we are available But we do not intend to have any conversation in any way whatsoever with activist shareholders. The right people to talk to are the management and the board of LSEG. And that's the way we operate. And we are available. Everyone knows our focus on equity markets.
Okay, Stéphane, on that note, we will leave it. Thank you very much indeed for joining us from Dublin. Stéphane Boujnah, the CEO of Euronext. Talking of tech, talking of AI, I want to take you to New Delhi. Sam Altman, the CEO of OpenAI, is speaking at the AI Impact Summit. Let's take a listen.
We'll probably need superintelligence to help us figure out the new governance mechanisms to ensure that this happens fairly at scale, and to avoid problems like extremely unbalanced compute access or something else. Second, we believe that AI resilience is a core safety strategy. We don't mean that this is the only safety strategy. We will continue to need to build safe systems and solve difficult technical alignment challenges. But increasingly, we need to start broadening how we think about safety to include societal resilience. No AI lab, no AI system can deliver a good future on their own. For an obvious example, there'll be extremely capable biomodels available open source that could help people create new pathogens. We need a society-wide approach about how we're going to defend against this. And third, the future of AI is not going to unfold exactly like anyone predicts. And we believe that many people need to have a stake in shaping the outcome. The development of AI has already held many surprises, and I assume there are bigger ones to come. We understand that with technology this powerful, people want answers. But it's important to be humble about what we don't know, and always remember that sometimes our best guesses are wrong. Most of the important discoveries happen when technology and society meet, sometimes have some friction, and co-evolve. For example, we don't yet know how to think about some superintelligence being aligned with dictators and totalitarian countries. We don't know how to think about countries using AI to fight new kinds of war with each other. We don't know how to think about when and whether countries are going to have to think about new forms of social contracts. But we think it's important to have more understanding and society-wide debate before we're all surprised. Of special note, and related to all 3 points, we continue to believe that iterative deployment is a key strategic insight, and that society needs to contend with and use each successive new level of AI capability, have time to integrate it, understand it, and decide how to move forward. This has been working surprisingly well so far. If we are right, and systems continue to improve at this pace, it's going to change the economics of a lot of things. A really great thing about AI progress is that it looks like many things are going to get much cheaper. We can have much faster economic growth. We're already seeing what AI is doing for access to high-quality healthcare, education, and more. In the coming years, we expect to see robots make many products and physical goods cheaper as supply chains get automated. The limit to how far this cost reduction can go may only be government policy. But the other side of this coin is that current jobs are going to get disrupted, as AI can do more and more of the things that drive our economy.
Sam Altman speaking at the AI Impact Summit, of course, in India, talking about maybe the need for a new social contract, talking about how he is still uncertain about how AI is going to be used by dictators and autocrats and fighting wars as well, but also some of the benefits that could come about as a result of this technology, including lower prices. Well, coming up, Air France-KLM reporting operating income for the fourth quarter that beat estimates. We're going to speak to the CEO. This is Bloomberg.
Thursday the 19th, good morning. 30 minutes to go until the opening trade. Futures look a little bit like this right now. We have a fairly mixed picture across the continent. London looks like it's going to outperform. Keep an eye on the oil stocks. Elsewhere, looks like we're going to see a fairly flat open. We have seen tech coming back over the last 24 hours. Does that rally sustain? I think probably remains a key question, Tom. What's going on in the bond market?
Hawkish Fed minutes, and we are seeing a very modest move higher in yields across the curve. In US Treasuries, we're seeing a similar picture in the sovereign debt of Europe. German 10-year Bunds then at 275, yields up just 2 basis points. Similar picture with OATs, of course, in France at 333. BTPs up 2 basis points in terms of yield. So a little bit of a modest selling pressure for the sovereign debt of the Eurozone. Gilts have been outperforming. We'll continue to watch those as well at the open at 8 a.m. UK time. That's a picture across the bond space.
Who's going to replace Christine Lagarde, I think, kind of is a question that's now coming into view as well. Let's get back to the corporate news that we are watching so carefully this morning. Air France-KLM has reported better than expected earnings in the fourth quarter and said it remains upbeat on the lucrative North Atlantic routes, in spite of heightened geopolitical tension and a little concern for maybe a few Europeans about visiting the United States. Joining us now is Ben Smith. He is the Group CEO of Air France-KLM. Ben, always a pleasure. Thanks for taking the time. The numbers look pretty much in line or above expectations, and you sound pretty positive on the demand picture. Can you just give me a bit more colour on that demand picture? How strong is demand?
Hi, Guy. Yes, we're quite pleased with how last year worked out. It's beat our expectations as well. With all the geopolitical challenges we've had, across many regions in our network, Western Africa, Middle East, and as you know, we still can't overfly Russia. But the transatlantic is a strong point for us, in particular the premium market, and in particular point of sale United States. And we've introduced a whole bunch of new products on the premium end, and they're being extremely well received in the market. And we're extremely well exposed to fully take advantage of that.
And you see that demand carrying on? That is not something that you see fading at this point?
Well, it's been pretty consistent for the last, I'd say, 3-4 years. And we have not seen, despite recent press on, change in people's travel patterns. We have not witnessed that ourselves at Air France-KLM. Point of sale US and point of sale Europe as well. In particular, premium, as I just mentioned, quite strong. We're not seeing anything in the near term that causes us any worry.
Ben, good morning. It's Tom alongside Guy. The other end of the cabin, the economy class, yields under pressure. This is a part of the cabin where Guy Johnson never sits, Ben. Does that story continue in terms of yields under pressure and economy? When does that story start to adjust? How much pressure is on those flyers, particularly when it comes to their willingness to spend?
Well, I think you got to look at, our groups in particular. Air France is 93 years old, KLM over 100 years old. We have very high costs relative to many other carriers. Very pleased to say, we achieved $2 billion in operating income last year in Air France, and it's 93 years, well over $1.2 billion. And the exposure we have to the premium cabin, reduces our exposure to the economy cabin. And even though we are seeing some softening in the economy cabins, it is far more offset in the premium cabins. So yes, there is a little bit of softness in the economy cabins, not only on the transatlantic, but also into Latin America and into Africa.
Which are the biggest cost headwinds right now? Is it wage negotiations? Is it airport fees? Is it the training costs of switching from Boeing to Airbus? What is the biggest cost challenge right now for the business?
Well, we've got something very particular in France and the Netherlands. We've got two countries, in particular the Netherlands, that have imposed new taxes and charges. And in the Netherlands, we have a government which is putting new artificial limits on the capacity at Schiphol Airport. So those charges are weighing down heavily. They were not in our original midterm plan. So despite those new charges and taxes, quite pleased to say that we've been able to cover those. The one key item that we're trying to, along with our European competitors, we're trying to address is the SAF mandates that have been put in place for European carriers that are not in place for our foreign carriers, our foreign competitors. And we're really lobbying to try to get a border control mechanism put in place, which has been put in place for other industries, such as the maritime industry, to ensure we're on a level playing field. This is a big concern of ours.
Sustainable aviation fuel, that's SAF. Ben, it looks like the stock is called 2% higher this morning, but it was 3% lower yesterday. And the reason it was 3% lower yesterday was related to what is happening in the Middle East right now. Oil prices have rocketed higher over the last couple of days on concerns that we are going to see a new Gulf War that could send prices significantly higher. I'm talking about Iran here. Ben, how hedged are you? What can you do to mitigate a rapidly rising oil price and kerosene price? Just give us some background on what you would expect to do if we see prices continuing to rise for fuel.
Well, the European airline industry, in particular our own, we're significantly higher hedged than our American competitors. In the U.S., most airlines are not hedged. We've got well over 50-60% of our annual fuel spend hedged. So I think we're in a very good position to weather any significant increase. Of course, it's never enjoyable going through so much unknown tension. But our exposure to that part of the world is relatively limited because of the heavy Gulf airline competition we have. So the exposure, if it is in the Gulf region or in the subcontinent or going into Asia, I think we're better positioned in terms of exposure than some of our other competitors.
Would there be an airspace concern? Airspace in that region, accessing east-west, the Asia routes, would also potentially be impacted as well. Is there anything you would be able to do if we were to see airspace closures at the moment? You're operating in a very narrow corridor already.
Yeah. As I said, our exposure to that part of the world is quite small relative to the size of our network. I mean, we have 200 destinations which we serve around the world. Northern Asia, we avoid Russia for now, but we're talking about a handful of destinations, 10 to 12 destinations that could be impacted if that narrow corridor that we use today to access, as an example, Bangkok or Singapore, if that corridor were closed off, as I said, we're not talking big numbers in terms of destinations.
Ben, before we let you go, I want to just loop back to the cost story. So from geopolitics back to the cost, and obviously oil prices feed into that. Is maintaining that margin target of 8% still doable, still realistic? What's your level of confidence?
I think under the current environment, very confident. I think reaching 6.1% despite this massive increase in taxation in our two major markets. I think it's a great achievement for us. I don't think many of our competitors would be able to achieve that kind of result in this environment. I mean, I've been in this business over 30 years, and this is I'm really, really happy and pleased with the whole performance of the team. So we're still on track to 8%. Air France is going on, firing on all cylinders. KLM, we're coming out with a new plan because of the new working environment we have there with the change in airport policy. No, I'm confident.
Ben, always great to catch up. Looks like the stock's going to be called a little bit higher this morning on the back of what you've delivered this morning. Ben Smith, the CEO of Air France KLM. Let's talk about this. Let's talk about also what's happening with Airbus, which is also out with numbers this morning. Bloomberg Aerospace reporter Kate Duffy joining us around the table. Good morning. Morning. What do you make? How big a problem could the Gulf be for European carriers if we see, significantly higher fuel prices? We've already started to see that coming through. But also they operate in a really narrow corridor to access kind of east-west traffic at the moment, which sits just north of Iran. How big a problem could that be?
It could be a real problem. Obviously, we've seen a lot of airspace tightening over the last several years, not only in the Middle East, but also with Russia and Ukraine. Airlines are constantly assessing the situation. Ryanair and Wizz Air, they've got plans to go back into Ukraine, but they can't quite trigger those plans yet because we just don't know what's going to happen with the peace deal or whether there will be a ceasefire. So it's very much a day-by-day situation. They look at it and they assess it and they go from there.
Fuel prices?
Yeah, that's to be assessed as well. Still very volatile.
Yeah.
Kate, on the Airbus story, so deliveries missing, but earnings coming in higher. Where do they land in terms of how they feel about this? How much of a blow is the miss on deliveries?
Yeah, I mean, January was a very slow month for them. They got about 19 deliveries. Let's compare that to Boeing. Boeing got 46.
Wow.
So we can really see the difference there between the two plane makers. Boeing is really in this period of ramping up the recovery. If you look at it now compared to last year, when it was really suffering still from this mid-air air blowout from the Alaska Airlines flight. That was a real issue for them, but they've come back with a new chief executive officer, Kelly Ortberg, and we can see they're really improving. Airbus, on the other hand, it does seem like from the results this morning, they are struggling with these engine issues. They particularly pointed out Pratt & Whitney engines, so these are the ones underneath the wing of their best-selling A320 jet.
This is a long-running issue.
This is a long-running issue, yes, and they have said that maybe it could be over at the end of 2027. That is very much in line with in line with what Wizz Air Chief Executive Officer Verardi is saying as well. But that's only dependent on whether there are any other situations that fall into play in the aviation industry.
Before he talks about building gliders, like how big is there any sort of sense of scale about how big a problem this is? Like, how many aircraft do they produce, and how many of those aircraft actually have engines to go under the wings?
Yeah, well, this was a problem that we saw last year, that they had all of these gliders in the hangars, and then there was a ramp-up, a race towards the end of the year to just try and get them out.
Put engines on them.
Absolutely, and as we know, the delivery targets are a closely watched metric in the aviation industry, because the more deliveries you get out, the more cash comes in. And so that's what they will be focused on this year, but it obviously just depends on the engine issues. Not only with Pratt, but also we've seen with Rolls as well. Like last week, United quietly dropped the A350 from their fleet plans. So that's something to watch as well, and that's over maybe the Rolls-Royce legal disputes. So there's lots going on with Airbus and the supply chain at the moment.
Oh, yes. Ongoing. Kate, thank you very much indeed. Aerospace reporter Kate Duffy joining us on this. We'll find out a little bit more on this story. Guillaume Faury, the CEO of Airbus, will be joining me. I'm going to be speaking to him at 10:45 this morning on The Brief. Looking forward to that conversation. There's a really interesting aside, just to link it to the AI story. So there's a lot of companies are now taking old jet engines, particularly off kind of things like 320s and 737s, and using them to generate electricity for AI. So they're basically taking old jet engines. And you take the big fan off the front, and you basically use it as a generating capacity. So because you can't get the turbines at the moment, there's such shortage. Remember we talked to Siemens. Such shortage of turbines. They're using jet engines for that, which could feed back into Kate's world as you get a sort of parts issue. But it's amazing that's where we are in terms of the electricity supply story for AI.
Well, it's good donut economics, isn't it? Recycling these engines and putting them to use. But it also shows the constraints in terms of supplying the energy needed for the data centres for the AI story. As we look at the supply chain story, at what point does AI start to help with supply chains? Better prediction, better in terms of forecasting of components to solve some of these issues, industrial design software, that kind of thing. Maybe that's further off into the future.
It's amazing stuff. Anyway, everybody's looking in every corner to try and figure out exactly where the electrons come from. Coming up, we'll get back to the earnings story.
I keep the same strategy because it is a good strategy and delivering results. And we change what is needed in this very disruptive environment, and especially we start to move outside Europe. Over the past 5 years, we succeeded our recovery in Europe. Now it's time to push outside Europe.
Renault's new CEO there on the company's global expansion plans. More on earnings next. This is Bloomberg. How you doing? 12 minutes ago until the opening trade. European equity futures looking a little bit mixed this morning. I suspect actually single stock stories are going to be quite interesting to watch this morning as we work our way through what has been a busy morning for earnings.
On the earnings front, profits at Zurich Insurance rising to a record in 2025, giving management a tailwind, of course, as that company pursues its £8 billion acquisition of UK rival Beazley. Group operating profit came in at $8.9 billion. That's just ahead of estimates. Join us now, very pleased to say, is Mario Greco, Zurich Insurance Group CEO. Mario, good morning. Are the tailwinds there, particularly when it comes to property and casualty, for further upside in 2026? To what extent can you build on the profit gains of last year?
Good morning. Yes, we feel we have tailwind for us in the markets, but it's not just the property and casualty. Life had a fantastic year. In 25, we're growing the business, and we feel that we can further accelerate the growth this year. Farmers, our management service company in the US, also had a record year with a a significant increase of number of customers, which again makes us very confident and optimistic on how to continue this year. So it's a good position we have in the markets, and we're confident.
You're confident, and you see further upside in 2026. There's a lot of focus, of course, on the Beazley deal. Do we get a binding offer before March the 4th? And how do you plan to finance this acquisition, Mario?
That needs to be seen. Now we are in a due diligence phase. We need to complete that, and then we will think about the next steps after.
But you have, just to follow up on that, Mario, you have financing in place? You are ready to go on in terms of the financing? I know we can't talk much about the deal, and I know that the UK regulators have pushed out the deadline for this, so you're still in the due diligence phase. But you have confirmed financing. You know how you're going to finance this deal if it were to go through?
Let's talk about all of that when we will get to a firm offer. And I'm sure that we can reassure everybody about how we will finance it.
OK, let's park that one for the time being and come back to it. Mario, insurance companies have been really volatile over the last few days. We've seen, obviously, concerns growing about how AI will impact this industry. How are you getting ready for AI? And do you think the recent turbulence has been overdone?
Look, AI is an incredible opportunity for the insurance industry. We are all in on AI. We're investing, we're using, we're testing. We want to bring AI to really revolutionize our business. I don't think there is any reason to fear it. It's a great opportunity. My concern is how quickly I can get the full power of AI supporting our customers, our business growth, but it's not about defending from AI. This is a great opportunity for the industry.
Mario, how much are you going to be spending on AI, and are you going to be reducing? Will you need fewer people, ultimately, as you implement AI?
Look, on people, the truth is we are actually hiring AI experts. So we're hiring competencies that we never had before. So very likely, net, it won't change very much the number of people, but it definitely changes the skills. Because people will be required over and over again in the next years to know what they're doing with AI, to be competent on that. And so they will either develop themselves new skills, or they will be people with different skills.
OK, switching focus a little bit, Mario, to the UK, to London. You're getting closer to launching your first syndicate, Lloyd's of London syndicate. Where are you in that journey? Why is that significant?
Look, as it is with the Beazley opportunity, we're actually connecting these two things. And so we will hold the launching of the syndicate until we understand better if there is or there isn't an opportunity to make a firm bid on Beazley.
Mario, just to kind of wrap this conversation up, what you've delivered here, according to the analyst notes that I'm reading this morning, appear to be very good numbers. They're ahead of expectations. The concern is that you are about to deliver a big equity raise. How should I read the share price reaction to today's numbers if it doesn't go sharply higher on the back of these figures? Do you think you'll be disappointed, or do you understand that the market is worried about that equity raise potentially being there, and that is a bit of an overhang in terms of the stock?
Look, when we went public on our intention to make an offer for Beazley, we wanted to hear our shareholders' reaction, and that was super positive. Our shareholders have been supporting us in the bid, have been supporting us in the strategical vision behind the bid, and have been supporting us on the financials of the offer that we were disclosing. So as long as I have the support of my shareholders and my customers, I feel very strong.
Mario, before we let you go, you're coming up for 10 years as CEO of Zurich Insurance Group. Do you get through 2027, Mario? Are there succession plans afoot?
I think I have a complete support also from my board to execute, complete this deal and deliver the benefits to Zurich customers and Zurich shareholders.
OK, deliver the deal. And you've got the backing to do that. Mario Greco, Zurich Insurance Group CEO, on the profit beat coming through from that business as well. We appreciate your time. Really interesting in terms of particularly the life part of the business, the property and casualty part of the business, their US exposure. But question marks about succession as well, because Mario Greco is going to be there for a decade. That time frame's coming up.
Does he become the next chair? I think that is the question a lot of people are asking, or anticipating that he will sort of step to that position. It's interesting on the Beazley story. He's going to hold off on the Lloyd's decision until we get some clarity on what that. He says he's got support of investors. The analysts are saying these are good numbers, but they're going to be held back by the fact that you potentially have a big equity raise coming to pay for Beazley, but you don't know. So you can't mark the stock up because you worry about the kind of the raise that's coming through.
March the 4th is the deadline for that, so we wait additional details. Coming up, it is the opening trade, of course. And let's check in on futures after a decent session. Bit mixed, currently pointing lower by around 0.2%, but after a strong session for European stocks yesterday. This is Bloomberg.
Welcome back. Thursday morning. Couple of minutes to go until the start of cash equity trading here in Europe. This is what yesterday looks like for the S&P. The S&P was up by around 0.5%. Decent rotation within the market, back towards tech a little bit. Market kind of reached its peak, actually, kind of at the time that Europe went out. That's the European close. We faded into the US close before getting a little bit of bounce. US futures are up a little bit this morning, so you can kind of continue that move. But nevertheless, actually from a European perspective, there's a little negativity that we need to price in. And that's why we're seeing what we're seeing in futures right now. This is the picture. Euro Stoxx 50 futures are down by around 0.2%. DAX futures are down by around 0.5%. FTSE futures are a little bit higher. Keep an eye on the oil price this morning. That could boost names like BP and Shell. You've also got the pound as a factor in the story as well. Look at what is happening in terms of future pricing for the pound. It looks fairly negative, and there's a kind of mechanical effect, or historically has been, around the FTSE. Pound down, FTSE up. So that's maybe what we're seeing this morning. A little bit of divergence, but basically what you are getting this morning is a little negativity coming from the States being priced into Europe, Tom.
It is another big day for earnings, so some individual stocks in focus as well. We're looking at Renault, we're looking at Nestlé, we're looking at Airbus. When it comes to Renault, it's a squeeze in terms of the margin story, increasingly competitive space. So the operating margin forecast coming in below the estimates, so watch that stock on the back of that story. Nestlé coming through with some pretty decent results as on the other side of the story in terms of targets, reiterating their targets, seeing that growth there. So that could see a bit of a boost. Airbus, the deliveries coming in below expectations, so missing on deliveries could weigh on Airbus gold.
The Renault call has just started. You can see the headlines trickling onto the Bloomberg right now. OK, here we go. Let's talk about this market open. We're expecting a little negativity to come through. CAC's going to be interesting in terms of the open we get from the French market on Airbus this morning. FTSE 100 is expected to go higher. Expect some of the commodity names maybe to deliver on the upside, but at the moment, a fairly flat open. We are expecting that to turn a little bit more positive. But the FTSE at the moment actually struggling to make headway. 600, that's just a reflection maybe of what we've got out of the UK at the moment. We're going to watch and see what the CAC does this morning. How bad could it be for Airbus? I'm going to talk to Guillaume Faury, the CEO, a little bit later on. We'll get his take on what is happening in terms of the engine problems that company is facing. The IBEX is out and it's down 0.2%. The CAC is down 0.2% as well. FTSE's just struggling a little bit, actually. We're expecting a little bit more positivity. We're not getting that this morning. We'll come back and find out exactly why in just a moment. We await the DAX and the SMI. Tom, what are you seeing?
The sector-by-sector breakdown. Top of the list right now is media, up 0.7%. Travel and leisure, up 0.6%. Energy, to your point about higher oil prices, Brent around $70 a barrel on those geopolitical risks story. Currently second in terms of the sector story on the upside. Up 0.6% is energy. Media gaining 0.9%. On the downside, the safe haven tilt to utilities. Utilities down 1.3%. Basic resources, after a strong session yesterday, currently dropping 1.3%. So basic resources on the downside. Media is the top performing sector right now. Beneath the hood, we're seeing, there's the Airbus story, then down 3.3%, 3.2%. On the other side of the print, you're seeing gains, pretty decent gains for Nestlé, up 2.5%, Guy.
Yeah, Nestlé certainly responding. New CEO over there talking about kind of rationalising that business around 4 core operating units, and the news out of Veve looking a little bit better now. So that stock up by 2.5%. But Airbus is the big weight this morning on the downside of the market. Actually, considering what people were expecting in terms of the calls I saw early on, a drop of only 3.3% looks fairly benign. Could have been worse, maybe is the message there in terms of the news out of Toulouse. Astra is also a weight. Iberdrola is also a weight as well. And you say some of the mining names are coming down as well. I just saw ASML. ASML's a little softer this morning, but I know that SAP is a little higher. Relex is a little bit higher as well. So some of those beaten up software names we've been talking about over the last few days may be coming back.
Let's get more analysis right now. Bring in Madeleine Ronner, Global Equities Senior Portfolio Manager at DWS. Madeleine, good morning. Thank you for joining us. Is it the earnings story? Is it Fed expectations, a slightly more hawkish Fed? Or is it modest, at least around the edges, renewed optimism around AI? What for you is the catalyst, at least in the near term, for equities?
I think actually a mixture between positioning for earnings, especially as we get NVIDIA earnings. I think that's one of the reasons. The second one is for sure AI optimism. So I think the news around OpenAI closing another funding round is something that reassured markets, because obviously they were getting a little bit of nervous of how dependent the cycle is on OpenAI. So their ability to get funding obviously is a huge factor. And you also clearly see on the software AI loser side, I would say, kind of a stabilization and the market trying to figure out more clearly which companies exactly could be potential winners, where the market has been overreacting over the recent weeks. So that's kind of what the market is currently trying to figuring out. And you see it today as well, and in the last few days, that a lot of these names started to bounce a little bit and saw a little bit of just stabilization.
Yeah. So, Madeleine, on that AI story, where do you think the disruption, or the overselling, I should say, has been most acute, in your opinion?
So I think it has been kind of, especially at the end of last week, it has been getting more and more, okay, what could be next? What is the next story? Where is anything sitting with software that was getting hit? And I think that is a little bit over-exaggerated. So what we are looking for is especially, obviously, proprietary data sets, which can be a continued barrier to entry, even as AI continues to move forward. It's also, obviously, because it moved also in the industrial space, for example, with industrial software, everything that here has to do with that is connected to hardware, we think is better protected. So these are areas that we look at. That's the one side of it. So just where we think fundamentally these companies are still well positioned. And the other one I would say is just where valuations have been hit so hard that you can say it's an over-exaggeration. That's really on a stock-by-stock basis, honestly. And this one is the harder one to do because obviously it's very hard to see how low multiples can go in that kind of situation, because there is a real risk of basically competitive barriers starting to decrease with AI and startups being able to provide very competitive products. And even if that is not, the whole seat discussion, even if that only goes basically into the pricing power of a lot of these companies and the gross margins that they've built up, obviously that's a huge shift potentially in the business model. So that's all something that you have to consider. But there are some names that have gotten under so much pressure on the valuation side that they're starting to look interesting again as well.
Madeleine, good morning. It's Guy. Are you de-risking portfolios, and will you continue to de-risk portfolios? And if you are, how are you doing it?
For sure. So I think we already had been under positioned in software, honestly. But exactly what I've just told you is what we've been doing. So not necessarily decreasing the overall software exposure, but generally shifting around what we have within software towards, again, where we think moats are just higher, where we think, again, the market has been overreacting. We saw yesterday, for example, EDA, for example, is a space where we have a higher conviction that barriers are there because of the proprietary data set. That's kind of how we started to de-risk, but it's honestly also difficult to just sort out, and I think that's what the market is struggling with as well, because a lot of companies tell you that their data set is proprietary and that this is giving them a benefit. So it's hard to disentangle as an investor, basically, where you have really high convictions. But yeah, so that's what we're generally doing. We obviously also had some positioning on the side of the more defensive sides of the market that have moved up quite a lot. And that is also something where we honestly right now getting a little bit more cautious again than we were at the beginning of the year, because these moves, obviously, for example, in the consumer staples sector have been quite large.
Okay. So we're struggling to kind of have a degree of certainty, particularly around some of the software stories. The VIX is at 19. Do you think volatility increases from here? Do you think we continue to see higher levels of volatility? And what impact do you think that could have?
I think with volatility, it has been very interesting because obviously the index volatility has been much lower than the single stock volatility, right? So on the surface, it looks pretty calm, but underlying, obviously, there has been a massive rotation. So I think that we think that can continue. So basically, index levels being stable, obviously for that, you would need the large hyperscalers to basically maintain on a more sideways note. And then the market broadening, just continuing, especially also as we see that the same thing happening on an earnings side, right? So in the last 3 years, the earnings have been very much heavily, earnings growth has been very much tilted towards the Magnificent Seven and the technology sector. And that is starting to broadening out. We see more of a cyclical acceleration potentially. We had a very strong PMI print in January. Yesterday, we got very strong industrial production numbers in the US. So there is a case that you can make for cyclical acceleration and a broadening out of the market that can continue. And that should help, especially like on a VIX and index level to keep volatility in check.
Madeleine, does that apply to small caps as well?
I mean, if you look at a cyclical acceleration, obviously, small caps are very interesting, right? And it has been a space that has been underperforming for quite a bit. This year, they've been stronger. So it is something that we continue to like. We have it on overweight, and we are positioned in our portfolios that way, and we continue to like it still. So it is something that you would want to have a larger positioning in if you are a believer in, again, a cyclical acceleration in Europe and in the US.
Yeah. How correlated do you think Europe and the US is? How correlated do you think Asia and the US is? If US equity indices go lower, how insulated are positions in Europe and Asia going to be? Are these absolute trades or relative trades, do you think?
I think we're actually more in a scenario where we have more relative trades. I mean, obviously, you also have to do markets like in the US, for example, go down of an overall level, or is it again what we see more? Okay, obviously, return potential right now is more limited than in the last few years. We expect more mid-single digit, high single digit upside, even though earnings growth is still very well supported. But we would expect like a slight derating of the US. Obviously, for Europe investors, then you could have like a weakening dollar again, weighing on overall returns for Europe investors in the US. That is obviously something, if you have that dynamic, that would help Asia and emerging markets. Again, that is something that we expect would happen. In Europe, I think you have also a lot of idiosyncratic drivers when it comes to the fiscal support, especially in Germany, that is coming. We are a strong believer that that will accelerate growth, and there will be some, again, kind of effects on the whole of Europe. And that could potentially lead to a stronger growth dynamic in Europe. So, I mean, last year we already had quite a bit of re-rating in European stocks. So the majority of stock performance last year really came from re-rating towards the US, whereas in the US we still had higher earnings growth. So we really do need to see that acceleration in Europe of earnings growth. And then that momentum we think can continue and valuations can hold or even still extend a little bit compared to the US. So there is a good case to make that even if we don't get a large downside, but just like a stable slight downside in the US, that Europe can still do quite well.
Does that growth, that potential growth picture in Europe, improved growth picture, does that unlock the European consumer, and how would you play that?
That's the hope, right? Because the fiscal stimulus in itself is not enough, obviously. It can be the trigger, the initial trigger, but then two things that basically need to happen. For one, obviously, we know European consumers have a lot of savings, so that can obviously help as soon as sentiment improves. That's the one thing, and that you can obviously play with the consumer sector. For example, luxury is also something that we still like. Obviously, that's also dependent on Asia. But it's also the private investments then as well. That's kind of the next leg. So you need policy to make Europe more basically attractive for corporate investments as well. So you don't only have the fiscal impact, but you combine it basically with deregulation, etc., to move not only to move like the consumer capital, but private capital as well. And I think that is the mixture that would be really, really powerful, and that is not yet priced in, and where markets are still a little bit skeptical and on kind of the wait and see mode.
Madeleine, great to catch up. Yeah, wait and see mode, definitely. Madeleine Runner, Global Equities Senior Portfolio Manager at DWS. Thank you very much indeed. Call 6 looks like this morning. What are we watching in Europe? We'll give you some of the earnings stories. Nestlé outperforming this morning, as you can see, doing very well on the back of what has been delivered today. Elsewhere, a little bit more mixed. Defence stocks are coming to the fore once again. Maybe a little bit of a fade on some of the tech bounce that we've seen over the last couple of days. Let's start off with what we're seeing out of Toulouse, though, this morning. Airbus front and centre for Chloe Mellet.
Good morning, Guy. Indeed, and Airbus is struggling quite a bit this morning. We're down more than 5% after it said that it will still be dealing with engine supply issues, and that will delay and complicate the production and delivery of its A320 jets. And that means that it might struggle to meet the record demand for that particular family of aircraft. And therefore, the shares are taking quite the hit this morning on the back of that. Moving on to Euronext, which is also in the red this morning, more than 4%. And that is after it said that costs will accelerate this year. And that is because of some strategic investments, but also costs related to the acquisition of the Athens Stock Exchange, which happened late last year. And so the earnings also came in a little bit softer than expected. So that coupled with the costs, that is leading to a little bit of weakness this morning. Pernod Ricard, however, is up 3% this morning. The first half sales were actually weaker than expected because of the continued weakness in demand for spirits in the US and China. But the company said that sales will actually accelerate, will do a little bit better in the fiscal second half. And therefore, that is what analysts and investors are focusing on this morning. And therefore, we are in the green. Tenaris is also in the green. This is a steel company, and that is because the outlook commentary implies some consensus upgrades according to analysts. And so we are up quite strongly, about 5.5% for that company. And finally, Arcadis is down quite a lot. This is a consulting and engineering firm. It is cutting headcount by about 1,000 roles and also expects really flat revenue this year. And so this is really leading the shares down. We're down almost 14% for that company this morning.
Chloe Mellet on some of the stocks on the move this morning. Thank you very much. Coming up, Nestlé planning a revamp then, including offloading its ice cream businesses. We'll bring you the details next. This is Bloomberg.
Welcome back. You're watching the opening trade. We are 17 minutes into the equity market session. The surprise actually is what we're seeing out of the London market, which is down today. So you've got some of the big mining names under significant pressure, and that is adding to the downside. Names like Rio. Some of the pharma companies are also softer this morning. You are seeing weakness in AstraZeneca, certainly acting as a big drag on that market as well. So the outperformance of London has not materialised.
The food and beverage space getting a lift from Nestlé, though, and that stock is popping in the session, up more than 3% right now. Nestlé saying its sales growth may quicken this year as the new CEO seeks to reorganise the world's biggest food maker. The company also reporting it's in advanced talks to sell its remaining ice cream businesses, as it says it will take a financial hit from the ongoing baby formula recall. For more, let's bring in Bloomberg's Gillian Deutsch. Gillian, what kind of stands out to you from these numbers? Investors reacting positively. Some pretty significant changes, though, being thought through at the top of Nestlé.
Yeah, Chief Executive Philippe Navratil is less than 6 months into the job, and his real task this morning was to really show he is serious about turning this company around, and he had positive news for investors who are really desperate for good news. The top line, of course, is predicting sales growth of between 3% and 4% this year. That's positive news for investors. Shares are up this morning. He also announced a reorganization of the company around 4 segments. That's pet care, coffee, nutrition, health, and food and snacking. Nestlé also confirmed a scoop from some of my colleagues that broke last night that they're seeking to reduce or sell its stake in Froneri, an ice cream joint venture they have. Includes brands like Häagen-Dazs. That might be familiar to some listeners. They also announced last night a board shakeup, brought in Thomas Jordan, the former president of the Swiss National Bank, and also Fatima Francisco, top executive Procter & Gamble. That's really to show that the company is taking governance issues seriously. This is on top of previous announcements of 16,000 job cuts, also moving away from the struggling vitamins and water unit sales. So it's a crucial year for Nestlé, and this is a good morning for Philipp Navratil.
Yeah, good way to start. One of the issues that certainly, though, that we are watching very carefully around this business is what is happening with this ongoing issue around tainted infant formula. What clarity can the company provide at this point, and what do we know about some of its rivals?
Yeah, that is certainly a crucial question this morning. Nestlé did kind of price in this impact of the recalls into their growth targets. And they did say that they estimate to be about 20 basis points that they expect to get hit from revenue this year. To just take a step back, this infant formula recall really began in December when the company found a contaminated ingredient from one of its third-party suppliers. That's ballooned into the company's largest ever recall, impacting consumers in more than 60 countries. And this is really going to play out in terms of both the recall costs, but also the reputational damage that it could perform for Nestlé, because we'll really see this cohort of parents, if they keep choosing Nestlé products or if they switch for the duration of their child's formula consuming years to an alternative. This will definitely be an issue as well for Danone tomorrow when they report results.
Yeah, that's interesting. So we watched that from Danone as well. Gillian, you talked about the potential spin-off of the ice cream business, Häagen-Dazs. What is the rationale for that? Why are they thinking along those lines? When could that happen? What is behind that strategy?
It's a great question. I mean, I think everyone thinks, oh, ice cream, that's a great business. And while they individually do perform quite well, they're really tricky business to actually have. So if you think of Unilever, they have actually just spun off their ice cream division as well. It's very capital intensive. It's also, obviously a lot of ice cream sales happen in the summer months and not so much the winter months. So it's a very kind of fluctuating business. So a lot of times these multinationals are taking a really hard look at their portfolios and saying, who doesn't fit in here? And the ice cream business, because it is so volatile, because it's so capital intensive, it doesn't often fit into these multinationals that are really trying to streamline their companies and say, okay, who are the big power brands? Who can we really put a lot of our capital, our marketing budgets behind and just see growth take off across markets internationally? And so I think Nestlé is taking a page out of Unilever's book and saying that's gone really well for them. They can focus more on things that don't require quite as much capital and are kind of these kind of power brands that are already succeeding.
Gillian, thanks for the update and the analysis. We really appreciate it. Gillian Deutsch joining us on the numbers out of Nestlé. Looking forward to Danone tomorrow. Let's talk about what is happening in the oil market right now. Decent rise yesterday, and we're picking up speed now in terms of what we're seeing with the oil price on the upside as well. This comes, of course, after we've seen these reports of imminent American military intervention in Iran. The White House warning Iran would be wise to take a deal. Paul Wallace joins us now to talk about this. Paul, we're starting to see a more significant move to the upside now beginning to develop in markets this morning. What do we know about what happens next and what the options are from a US point of view vis-a-vis Iran?
Hi, Guy. Well, I think you've got a number of things happening here. You do have the US military continuing to build up its forces in the Middle East, in and around Iran, around Iran, let's say. And, it's already got a massive amount of firepower there in terms of ships and jets. But it's, another aircraft carrier group is on its way, a second one. Publicly, the next thing that's meant to happen is Iran is going to send to America written proposals about how to bridge the gaps they still have in their ongoing talks. We had the second round of those talks in Geneva on Tuesday, and it sounds as if Iran has, roughly 2 weeks to get back to the Americans, and then if they're broadly satisfied, the Americans will say, okay, let's go to round 3, and we don't know where that will be. But of course, there are plenty of people, including in the oil market, who think America might be essentially trying to lull Iran into a false sense of security and maybe willing to strike the country, before Iran, returns with those proposals, because that's, in some senses that echoes what happened in June last year with the 12-day war between Iran and Israel, and then America at the end. That will happen when, or at least it started when the US and Iran were in the middle of nuclear talks, and so there are potential similarities this time around too. However, publicly the Americans are saying they are going to give diplomacy a chance. They want the talks to succeed. They say those will be very difficult because negotiating with Iran is anything but easy. However, that doesn't rule out imminent strikes.
Paul, if we do get those strikes, and we continue to monitor, of course, the talks between Iran and the US that, as you say, are paused now, it seems, or are coming back maybe in 2 weeks' time. How vulnerable is the Strait of Hormuz? Is there a way for that to be kept open in the event of a strike? Is that the option Iran goes for, particularly if Israel is pushing for regime change?
Exactly, and I think there are a lot of questions. Even if the US does strike with or without Israel, how it goes about that, what exactly its intentions are, matter a lot. If it's sort of a one-off strike and Trump quickly comes out and says, look, we're not going to do anything more, let's just end this now. He claims victory and says he's taken out, Iran's ballistic missiles or whatever the case is, then Iran might not retaliate in too aggressive a fashion. However, if the US decides to go for regime change and, effectively say we're not doing a one-off strike, we're going to continue this until there's something like a change of regime in Iran, then in that case, I think that's the situation where Iran is most likely to be very aggressive. It may not shut Hormuz, but it could well attack some tankers that are going through it. And of course it could attack US bases in the region and Israel itself. So all these things on the table. Just to note, in June, during the 12-day war, Iran did not really attack any, let's say, energy facilities that are crucial to global energy markets, and neither did Israel when it came to their attacks on Iran. So oil did rise at during that war, but it came down pretty quickly. But that doesn't mean there's going to be an exact repeat if we see strikes again.
OK, Bloomberg's Paul Wallace. Paul, thank you very much indeed. An important update as we continue to monitor that region. Of course, there is a bit more risk premium in the oil markets today, with Brent at $71 a barrel, so up 1%, WTI at $65, close to $66 a barrel, Guy.
Yeah, we've come up quite quickly. And I think the kind of the rate of change is going to be really interesting to watch in terms of what we're seeing with the oil price. Regional crude, like Dubai, is trading above Brent. So that tells you that the region is actually quite concerned about what is going on here. OK, we continue to monitor that, of course. Up next, though, we're going to get into the tech story. We're going to focus on what's happening in terms of AI disruption, but also Europe and deep tech. We're talking defence, space tech. We're going to be speaking to Kembara co-founder Yann de Vries about his vision and that fund that they've just raised. Stay with us. This is Bloomberg. This is the opening trade. We're 30 minutes into today's session. So after some very strong gains yesterday for European stocks, a bit of downside pressure coming through right now. Down 0.2% on the benchmark. The DAX is off 3 tenths. Airbus is a weight on the CAC current. That index is currently down 0.3%. Airbus is under pressure. The FTSE 100 also down 30 points, having had a very strong year-to-date session, or gains, I should say, for the FTSE 100. The flip side on the positive earnings story is Nestlé. Guy, what are you looking at? Let's take a look at how the internals look this morning. Quite balanced, actually, is the takeaway from what I've seen in front of me. In terms of the stock 600, 278 up, 301 down. So kind of 1 for 1. Not quite, but kind of just about 1 for 1 in terms of what we're seeing on the internals. Volume's a little light, but not by much. You've got a lot of single stocks that we need to work our way through in terms of the earnings picture. Air France-KLM up very strongly this morning. That's the demand story. Ben Smith talking positively about that. Still sees the North Atlantic being very strong. Still sees the front of the plane being very strong. That's where Air France-KLM France-KLM makes its money. We also saw the stock dropping yesterday, so just be aware of that. We saw, obviously, the higher oil prices, seeing airline stocks come south, so we're just kind of recouping some of that as well in terms of the position that we're getting. Orange is up by 5.45%, but the real standout story, I think, on the upside in terms of the weight this morning we're seeing in the market comes out of Burberry, comes out of Nestlé. New CEO coming in. 4 lines are now being talked about in terms of the focus, and the stock is responding positively to what we're getting in terms of the reorganisation. Downside looks like this. Airbus is the big standout story on the downside. Yoon, CEO of Airbus, building gliders effectively. Ongoing issues with engine availability for particularly the A320 lines. That stock is down by 3.2%. Rio is a real weight on the FTSE 100. We're expecting the FTSE to be stronger this morning, but Rio on the downside, down by 3.21, and Arcadis down by 14.16. So some real mix of stocks in terms of driving the downside performance this morning. Feels like a single stock story, but obviously there's that kind of index rotation that we're getting as well that we need to watch out for, Tom.
OK, here's what else you need to know this Thursday morning. Former South Korean President Yoon Suk-yeol has been found guilty of leading an insurrection and sentenced to life in prison over his 2024 martial law declaration that triggered the country's most severe political crisis in decades. Yoon can appeal the ruling, which would proceed to a higher court and could take months to resolve. Fed officials appeared wary of cutting interest rates at their January meeting, with several suggesting the central bank may need to raise rates if inflation remains high. The minutes of the meeting showed most officials believed last year's labour market weakness was fading, and that the risk of more persistent inflation remains. And Bloomberg has learned that OpenAI is close to finalising the first phase of a new funding round that is likely to bring in more than $100 billion. The record-breaking financing deal would give the startup additional capital to build out its artificial intelligence tools. Guy.
OK, let's stick with that AI theme. The president of Microsoft said the company is on track to spend $50 billion by 2030 to expand AI infrastructure to the global south. Brad Smith has been speaking with Bloomberg's Linda Armin on the sidelines of India's AI Impact Summit.
I think it remains a critically important partnership for Microsoft. We bet on each other, but it's not as exclusive as it was, say, a few years ago. OpenAI uses our compute, they train models in our data centers, but they work with other companies as well. We critically rely on OpenAI's frontier models. They are among the best. On many days, they are the best in the world, but we have a relationship with Anthropic. We use open source models. We're developing our own models. So on both sides, we work with more partners. But I think the partnership between the two of us remains an imperative. It's a huge priority for us at Microsoft.
The question is why? Is it a hedge? Is it a strategic pivot? How would you describe that move, looking at alternative partners?
Well, look, if you want to think about the partnership between OpenAI and Microsoft, all you have to do is ask one question. Would any of this generative AI sector even exist if the two of us had not come together? OpenAI created something that no one else even understood was possible when they launched ChatGPT. And OpenAI could never have created that without Microsoft's compute and really frontier data centers on which to train that. We built something special. We'll each do special things on our own. We'll each do special things with other companies. We'll each do, I think, very special things with each other.
Just one final question, because we're running out of time, apparently. Copilot, is it losing traction?
I don't think so. It's gaining ground. It's getting better every week. It's getting better every month. I say this as a user, not just of M365 Copilot, but our consumer Copilot, our researcher agent, our other agents. You know, we're seeing usage grow. We will continue to add features and functionality. I personally think it is an important part, not just of Microsoft's past and present. It is a key part of our future. It is a key part of, I think, making everyone more creative, more productive. I certainly find that in my own work each and every day.
OK, the president of Microsoft, Brad Smith, speaking to Linda Armin over in India at the AI Impact Summit there. And as that summit in India continues, the scale and scope of the technology around AI is proving difficult for investors, certainly, to pin down. Kembara is the first dedicated UK and European €1 billion deep tech growth fund. Growth is an important part of that story. Investing in AI, robotics, space and clean energy. The fund recently launched with a first close of €750 million. Yann Vries, co-founder of Kembara, is with us now. Yann, we want to get onto the deep tech story. How do we draw the dots between OpenAI raising $100 billion with a valuation north of 800, maybe $850 billion, with what you are doing? Is that good news for European deep tech? Are you comfortable with these kind of numbers? You've had deep experience in the tech ecosystem. When you see these kind of numbers from labs like OpenAI, how do you respond? How do you react?
Look, we are going to be riding the wave of AI. I think we are investing in deep tech. So this infrastructure that is being built out is actually good for us. This is going to unleash a lot of innovation in science and technology.
Is it sustainable?
So the demand out there for AI is we're just at the beginning of this massive transformation. It's going to transform all our industries. And so we're just at the beginning of this huge demand. They actually cannot build fast enough to compute globally. AI will be pervasive into our societies, in our education, in our governments. So I think that is sustainable. What is not, but where there's froth, however, is in the investors are still trying to find out where the long-term value is.
Yes.
And AI is completely reshuffling these cards, right? So incumbent software SaaS companies are now being under attack, both from the AI platforms like Google and OpenAI, but also from hundreds of startups that came out overnight, which have now AI to build new software services at a fraction of the cost. So this is completely unsettling this whole software ecosystem, and that's why you've seen a lot of readjustments in the multiples of some of these large software companies, and that's creating tension. We're not operating there. We're operating on the deep tech side of things. So we're looking at companies that have deep science, big scientific breakthroughs. They're solving massive global problems like climate change. You're not going to solve climate change with software. You're at the intersection of science and hardware, and we're leveraging AI to make these big scientific breakthroughs. So that's what's the interesting part.
So when you look at the market ruptures that we've seen in the software space in the last, few months, frankly, does that make you more comfortable with leaning into deep tech? That you want more exposure to deep tech, even though it's a longer term horizon in terms of getting the returns?
Deep tech is where the future is in terms of, I think, making returns. The big difference with deep tech is you have very strong moats. You have lots of IP. These companies are doing mission-critical stuff, and it's very different from software companies that have almost very little defensibility today. And so that's the first part. And then you have almost unlimited upside. Look at companies like SpaceX or NVIDIA. If you crack a big global problem, you can create $100 billion plus companies. Now, on top of that, with the geopolitics today, Europe is finally realizing that it needs to own these strategic technologies. So there's a massive $1 trillion program in Europe to back deep tech across space, robotics, AI foundations, etc. And so we have tailwinds behind us. And deep tech initially was very capital intensive. But today, what you can do is you can actually leverage these non-dilutive financing tools like debt, like grants, to actually scale these companies, build these factories, and while not necessarily diluting massively the early stage investors. We're going to help those companies do that. This was not available 3-4 years ago. SpaceX was actually a great success story for that. They raised more than $30 billion. Elon Musk still owns probably 40% of the company. So if you do this right, you can scale those companies into giants. You can solve massive problems, and you can create outsized returns for investors. That's what we're focused on.
What needs to happen to achieve all of that? What are the biggest problems, bottlenecks that you face right now?
So Europe doesn't have an innovation problem. It doesn't have a startup problem. What it has is a scale-up problem.
Okay.
The biggest problem today that Europe has is it doesn't have anybody today that is focused on deep tech that can lead $50 to $100 million rounds.
Right.
And that's what we are doing. We have a specialized team that has been in the space for the last 25 years who knows how to scale those complex businesses. And we're here to help these entrepreneurs go from lab to global scale. This is the critical missing part. And the people, the founders are not able to get this financing. Either they go to the US to scale over there, or they're sold on the cheap. Well, look at what happened with DeepMind, right? Sold for $400 million. Today, they are the forefront of Google's AI engine. Yep. And look at the opportunity cost for Europe to lose minds like that.
Are you big enough? Do you need to be bigger?
So look, this is just the beginning. It's the first one. It's actually a huge step.
How big do you need to get?
We don't need to get bigger because the sweet spot for us is a Series B and C.
Okay.
That's where you're at the critical inflection point for those companies.
Okay. Do we need more of you then?
Yes, definitely.
Okay.
Yes, Europe needs more capital, more growth capital, more funds like us, for sure, to stay competitive.
So how do we make that happen?
So there's a lot of initiatives underway. We actually were one of the beneficiaries of the EIF ETCI program. They put 350 million to anchor a fund. That was a huge way to get us started. There's other funds that are getting these. And then on top of that, there's a big scale-up fund now in Europe, which is actually planning 5 billion to 20 billion to do big rounds of 100 million into those scale-up rounds. So lots of initiatives are on the way in Europe to make that happen.
When do we see the effects of those coming through? When do we solve this scale-up problem? How quickly? Is it going to be a year, 2 years, 5 years? How quickly do we solve?
This takes time, right?
Okay.
But the good news is we're here now. We can help those founders. There's lots of gems in Europe that are ready to scale.
Yeah.
And we can unleash a lot of
Let's talk about some of those gems, because you do collectively have that depth of experience. And some of the names there in terms of what you and the team have invested in the past. SpaceX, tick. Palantir, tick. OpenAI, tick. Lilium, cross. What happened with Lilium?
So I was there for initially as an investor in the Series A for 3 years on the board, and then I joined the company full-time, and I helped them scale from 200 people, roughly to 1,000 people until the IPO. The big problem with Lilium, this is actually a good example of what Europe didn't do well.
And this was a flight startup, an aircraft startup.
Yes, one of the most ambitious deep tech projects in Europe, an electric aircraft.
And they went bankrupt ultimately.
They went bankrupt, sadly. But they didn't go bankrupt because they didn't have a great team or didn't have great technology. They went bankrupt because they were struggling to find growth financing. It was incredibly hard to find people who want to invest in hardware, in new engines, in new batteries.
So if Kembara had existed then, Lilium would be
in a much better space. Yes, absolutely. Absolutely.
Okay. Which part of deep tech? It's funny. Some of our producers are asking what is deep tech, but they think they've been educated now. I don't want to dismiss them, but we were questioning what deep tech was, and I think they've got better answers. They've got some answers now from you. Which parts of the deep tech ecosystem are looking most attractive to you right now? Is it space tech? Is it defence? Is it renewable energy? Which parts of defence tech?
You know, the good news. It's across the board, and Europe is actually playing its strength now. So future of compute, quantum computing, new AI chipsets, there's lots of interesting things happening there. Climate is not going to be solved, and the US is turning its back to it. Europe has amazing technology there, so we're going to be looking very closely at that.
Haven't investors turned away from climate? Aren't they less attracted to that?
So some in the US, yes, but actually there's a lot of really good funds that are now looking at Europe to invest because they're really struggling in the US given the geopolitics.
Okay.
So this is actually a good time to invest in climate right now, if you know what you're doing.
Okay.
If you know what you're doing.
If you know what you're doing. Yann de Vries, fantastic. Really interesting insights. Thank you very much indeed. Co-founder of Kembara on that €1 billion deep tech fund. Coming up, different type of technology, online travel platform Booking is planning a share split after becoming one of the highest price tag stocks on the US market. So we're going to ask you just how much have the shares rallied since the dot-com bubble? Take a punt. The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked how much have shares of Booking holdings risen since the dot-com bubble? The answer, about 16,831%. The growth of its online travel business driven a significant rally then in the stock over the last decade. That's an understatement, leading it to become one of the highest price tag stocks in the US equity market. The shares hovering at just over $4,270 a piece at the close yesterday. The sky-high stock price then leading the company's board of directors to approve a stock split that will give investors 25 shares each for each one they own. I think we're showing pictures of Miss Piggy because there's some advertising going. Miss Piggy has been recruited to some of these.
That's not Miss Piggy.
That's not Miss Piggy. That's a different character.
Morticia.
Morticia, yes. Picking, I think, spooky holiday destinations, but Miss Piggy is into luxury.
Yeah.
And that is very much where Guy Johnson sits.
Absolutely. Wednesday, obviously, has been a huge. That's why I guess they're using Morticia. Yeah, my kids call me a Muppet on a regular basis. I thought that's probably how you were going to transition back to me. OK, Tom, thank you very much indeed. Let's carry on the conversation, talk more about these markets. Skylar Montgomery-Koenig from Bloomberg MLive and Bloomberg senior strategist Michael Masika joining us around the table to discuss. OK, I got various things I want to discuss. Is the Fed about to hike rates? The answer is probably no, but potentially at some point soon. Is tech making a comeback? Skylar, What do you think?
Which one do you want me to start with?
Let's start with tech.
Yeah, okay. So I think what we've seen yesterday is a more sustainable bounce. And I say that because I think what we've seen over the last couple of months in this rotation is more of a valuation adjustment in terms of you're going from stuff that's very expensive into stuff that's less expensive, but it's not selling of all tech. And by that I mean if you plot the tech weight in MSCI indices globally versus performance over the past 3 months, that's still upward sloping. So a higher tech share still means that you're outperforming. Now, admittedly, that's quite skewed by what's happening in Taiwan and Korea. But it just means that you can't just sell all tech and you can't just buy stuff that has very low weights of tech. And so as we get to better earnings and de-rating and better prices, then people are increasingly saying, I want to buy the dip.
There's a bit more nuance in the story there. I saw there was an intake of breath from Skyler when you said, I think this is becoming more rational or more nuanced and more balanced at the rotation, or more sustainable, I think you were saying, in terms of the rotation. How do we think... The markets didn't seem to react too much to what looked like a pretty hawkish Fed in terms of the Fed minutes that came out. Does that become a risk for the markets, that there's some voices suggesting they may have to think about rate hikes at some point?
Yeah, I mean, I think there's a different market reaction for equities versus fixed income in the dollar. So we have seen yields bounce, especially because the 10-year was approaching that kind of key 4% level. I think it makes sense, right? We're at neutral range, right? Some of the estimates that we have are there. And so at that point, you need a more symmetric policy reaction. You need to react to what the incoming data is telling you. Now, on the data front, growth has been very strong. Inflation's a bit softer, but core PC in particular is very sticky around that 3% level. And so you need to be thinking about hikes, certainly. Now, because that's growth motivated, it's not necessarily negative for equities. It's only when it's supply-driven inflation that's forcing the Fed to hike that it's very negative for equities, but it can still be negative for bonds and positive for the dollar.
Okay, let's bring in Mike on this. US equity markets are going sideways. US growth is really strong. Tell me what's going on here. I would have thought the super strong pre-midterm growth would drive earnings, which would drive US indices. Why is it not happening? And what does it tell us about what's happening really below the surface, not on an index level?
So, it's still happening. Like, you have very strong growth. You have results coming in from companies that are pretty positive generally. The thing is, you have such a big weight of those mega cap tech stocks in the benchmark that if they don't do well, the benchmark doesn't do well. And actually, you get the consequences of that into portfolio management. We've been talking about that the fact it's a stock picker's paradise. It is actually. Since the start of the year, 57% of mutual funds in the US are outperforming the benchmarks. That hasn't happened for the past 20 years. About that.
Or maybe stock pickers are finally outperforming.
Yeah, exactly. Because you buy anything but the mega cap tech that you can't own at a proportion at the same level of the benchmark, because risk management would not allow you to. That you are actually outperforming, because those stocks are not doing well.
This isn't just I'm amazing at stock picking. This is just I'm not allowed to own that stuff, so I just have to own this stuff, so I'm going to outperform.
Yes.
Excellent. It's the anything but mega cap tech trade.
And there's a lot of that as well. I mean, the mega cap, you got a lot of software companies. The software company, people have a lot of exposure to them. They're dumping them. You've seen it. All the Oracle, all the Workday, etc. Even the ones that are kind of supposedly immune to the AI disruption, like Microsoft. They're not doing well. They're not doing well this year. So the exposure is being reduced in all that cohort at a very fast pace, and the result is you go into other sections of the market, you make money because those other sections are doing very, very well. But at the same time, the benchmark isn't doing anything.
Isn't doing anything.
Exactly.
Walmart's out later. How big a tell is this going to be?
I mean, it certainly gives you more information on how strong the consumer is. I think I'm more interested in kind of the aggregate level data. I think increasingly, yes, the economy is K-shaped, but it's maybe not as increasingly K-shaped as some people are talking about, in terms of we're not heavily reliant on these top consumers, more so than we were 10 years ago in a significant way. So yes, I care what the bottom end consumer is doing, but I also care more about what will PCE data tell me. Is the consumer strong in general? Is growth holding up? Looking forward, we have more fiscal coming in the pipeline in the first quarter, and we're going to get that bounce back in GDP in the first quarter. from fiscal, but also from shutdown related, from inventories no longer being drawing down. And so I'd rather look forward and at overall growth.
But when does the market start to go, actually, the midterms are in November. I'm going to put a date on this. Say they're 3 months away. Does the market go, after the midterm, there's no fiscal? In fact, we get fiscal drag, and we start to see a more negative picture emerge. At what point does the kind of the positivity from the fiscal push that we're seeing,
and you could potentially get a divided US government,
start to fade?
2.7% growth is the expectation at the end of this week. We got a Bloomberg piece on the terminal today about a boom in the US, a jobless boom in the US. So if we have a jobless boom in the US, that's going to be a drag, presumably, on the consumer at some point. How do we think about that?
Yeah, I mean, I think depends on when you think about the labor market, the supply and the demand side. So yes, you don't have a huge number of jobs being created, but you've had supply come down quite significantly because of restrictions from immigration. And so yes, you might not be having jobs created, but it doesn't mean that you're necessarily very worried. I think you start to get worried when you have unemployment rise, when people are losing their jobs, because that means that you get less consumption because wages are no longer being picked up, and that feeds very negatively into profit margins.
How will the market react if oil prices go sharply higher from here? If we do get conflict in the Middle East, in Iran, oil's up quite sharply again this morning. If that continues, how much of a financial market problem could that be?
We've seen it in the past. When that happens, you get a very short-term shock, usually. And it's very concentrated into oil stocks and like...
It wouldn't be seen as an inflationary issue.
It will feed into inflation, but the thing is, like, the interest rates are already still quite high in the US. The ECB is down cutting rates. The next move will be a move up. It's almost guaranteed. Not this year, but probably sometime next year. So at the end of the day, the inflation worries is not there yet. And you would need a real oil shock to have one. That's what it seems like at the moment.
Okay. Thank you very much indeed. Of course, Bloomberg M Live, Skylar Montgomery-Koenig and Bloomberg Senior Strategist Michael Masika on these markets and that potential geopolitical impact as well. We continue to monitor Iran. Meanwhile, the India AI Impact Summit sees Modi, Macron and tech leaders attending. We continue to get interviews and sound from that major AI and tech event. And at 1:30 p.m. UK time, we're going to get US initial jobless claims, talking of the labour market in the US, followed by Euro area consumer confidence at 3 p.m. UK time. And Walmart, Guy mentioned this, delivering earnings results before the market, plus money firms Newmont and Dropbox after the market. And more Fed speak today with Bostic, Goolsbee and Kashkari.
Rafael Grossi is going to be joining us shortly, Director General of the International Atomic Energy Agency, on the pulse in around 15 minutes' time. That as we continue to monitor what is happening in the Gulf very, very carefully. Tessa Randos is going to be joining us, co-CEO of Netflix, a little later. This is Bloomberg.